Welcome back. You're still tuned into Halftime Report. Let's go across to our special Outlook 2026 series. India had a Goldilocks 2025 with growth likely to be at 7.5% and inflation at 2%. And yet the rupee struggles and Indian stock indices were underperformers compared to US or North Asia. My colleague Lata Venkatesh caught up with Neelkanth Mishra, who's the chief economist at Axis Bank, and began by asking their FY27 growth forecast of 7.5%. Listen in to a slice of that conversation.
Yeah, so I will start with what I've been repeating, and I'm quite surprised and shocked that economists can still see a stimulus in FY26. This fiscal year. See, the way I see the Indian economy is that in FY25 you had simultaneous fiscal and monetary tightening. The fiscal tightening was explicit 80 basis points, and on top of that, there was another 50 basis points where the government collected GST compensation cess, but was retiring some off-balance sheet debt. There was 130 basis points of fiscal consolidation in FY25, the last fiscal year. And on top of that, because of the letters sent to some of the large private banks, credit growth slowed very sharply. And that itself was equivalent to more than 2% of GDP worth of monetary tightening. So if credit growth slows, obviously GDP growth will slow as well. So the economy delivered 6.5% despite significant fiscal and monetary tightening. In FY26, I think, again, I'll reiterate, I've been saying this from budget day, that the tax cuts were not a fiscal stimulus. The government was still bringing down its fiscal deficit. That is simple macroeconomics, that 4.8 going to 4.4 means that the government is a drag on incremental demand, on aggregate demand. And therefore, the economy this year, till the time that the GST cuts happened, which actually kind of neutralized some of this tightening, the economy was still facing headwinds on the fiscal side. On the monetary side, at least, the incremental headwinds faded. So it's almost like, if it's like a maybe class 3 maths, that if an aircraft is on the ground speed is 700 kilometers an hour, and there are headwinds of 250 kilometers an hour, if the headwinds fade to 100 kilometers an hour, what will the aircraft fly at and on the ground? And that's exactly what has happened this year. So the growth surprise for many people was not something that was a surprise to us. We expected that as the headwinds ease, the trend growth will start showing up. FY27, the fiscal becomes even less of a drag. So this whole narrative that, the government doesn't have fiscal space has been true for the last 5 years. In fact, the pace of fiscal consolidation is now slowing. So now you have, we are forecasting 4.2, but let's see what the government throws up in the budget. So only 20 basis points versus the 40 basis points that happened in FY26. And the monetary, all the easing of conditions, the fact that there is now a firm vision or message from the central bank, I think credit growth is starting to revive. That can become a tailwind. So we can run the economy above trend for a while, and that is why we are at 7.5%.
Okay, well, fair enough. Let me come to earnings. Time permitting, I'll get back to the macros of inflation, etc. later. But earnings has been our bugbear. Do you think we are going to get to high single digits or double digits? And what gives you that confidence?
So both macro and micro. So you have the 12-month forward earnings, which frankly is what matters. So you had a very nicely upward sloping curve, and then the last 12 months it has flatlined. Because whatever you gained from the roll forward, you gave up by the pace of cuts. So you're seeing like 3% plus cuts every quarter in index EPS. Our expectation is that as GDP growth stops disappointing, because many of these trend indicators were below what was expected in terms of momentum earlier, especially on large sectors like autos and financials. And so once this starts to revive, the pace of cuts will start to slow. And therefore, the 12-month forward earnings then resumes its upward climb. And our forecast published in the report is that the 12-month forward is likely to rise by about 14% in the calendar year, CY26. The second approach to that is to look at assumptions sector by sector. So there are 4 sectors which account for nearly 2/3 of index EPS, which is financials, IT, industrials, and energy. And in all these 4, the assumptions look reasonable. I don't want to bore you with all the details, but the gist is that the CY26, and therefore, and you're absolutely right, if the 12-month forward earnings start to climb, our weights in passive indices start to go up, our market either becomes cheaper or starts to climb, and then FII flows start coming back, and a lot of other factors then start to stabilize.